Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today is UTI AMC's Head of Equities, Ajay Tyagi. The case for the chat for this conversation today is simple. At the end of the year, what we want to do is try and understand whether the valuations are a headwind for our markets or do they still provide some more room for an upside. What to expect from Q3 earnings and can earnings provide the trigger for a further up move? And of course, which sectors have good valuations to invest in right now? And that is always a relative question with markets trading at all-time highs. Ajay, good having you. Thank you so much for taking the time out and speaking to us today. I hope all is well.
Yeah, thank you, and thanks for having me on the show.
Now, the pleasure is entirely ours. Ajay, these are questions that everybody ponders with at the end of what turned out to be a rather successful 2023 for all forms of market caps. What does 2024 look like, or what does 2024 have in store? How would you think about it?
Sure. See, I think you summed it up very well. This was a year which turned out to be unexpectedly good, despite the events that we had in February, and also the fact that for pretty much the larger part of the year, we were used to listening to higher for longer. Despite all of this, the year is ending on a very solid note. The only piece of caution here for all investors is that valuations clearly are not in our favor right now. While all segments of the market have done well, but I would say that small caps are the one which have done exceedingly well and to some extent unwarrantedly well. So we would be very cautious in that segment. In terms of valuations, I can just put the framework for you today. On a relative basis, large caps are the cheapest, small caps are the most expensive compared to their own history, of course, and mid caps are somewhere in the middle. While even large caps can't be termed as favorably placed compared to their own longer term valuation averages, but relatively, certainly they are more attractive than mid and small. Yeah.
Okay. Ajay, could it happen because of earnings growth that, because small caps and mid caps are such a wide bucket, particularly the small cap end of the market, and there are so many of these companies that we've spoken in the last 2 months, which are speaking of some very promising growth / capex because business opportunities have opened up. So could it be that under this overarching view of how small caps and mid caps are a lot more expensive and large caps are safer, that there'll be a clutch of smaller names, promising names with high growth, which might continue to do well in 2024 as well?
Absolutely right, Niraj, and I would say that is always the case. Let me just take you back to what happened in 2018 and 19. After a very strong rally in mid and small caps in 2016 and 17, we finally did see the mid and small caps starting to underperform pretty much from January 2018, if my memory serves me right. But like you just said, while there was a bit of a bloodbath, if I may use that word, but even during those 2 years, there was certainly, some very strong business models which defied this correction and, kept moving up basis the earnings momentum and basis the growth in their profitability and cash flows that they continue to witness. So yes, I would say that's always the case, and therefore it's incumbent on all investors to not just get carried away because there is a general momentum in a particular theme, but to always, lift stones and figure out which ones are really worthy of holding on to as strong businesses. Yeah.
Okay. And, I'm going to talk to Ajay Tyagi about that in an extended conversation on the other side of the break. But before that, Ajay, what are the risks to what is sounding like an extension of what has been India's year? Yes, Indian markets have done well in line with the other markets, but everybody says that 2024 could very likely continue to be India's year, expensive as it might be. What are the risks to this?
See, the beauty about our business, Niraj, is that the risks are evident only when the event has happened. So yes, we can prepare for those risks, but sometimes some of these, exogenous variables come and hit us unannounced. But let me just call out a few as we always, think about them. The one risk obviously is geopolitics. We don't know which way the current situation in West Asia is headed. Hope not, but if this situation was to, lead to a bigger conflict in the region, crude prices would certainly start to boil up. And that's never good for a country like us, which is still dependent on importing of crude oil to the extent of 80%. So that obviously is one big risk. It would also lead to uncertainty in global markets, which generally leads to risk off. And risk off basically means that you take money out of the most riskiest part of the market, which is certainly emerging markets. So flows into India may also get impacted. So I would say on an immediate basis, what can disrupt us is this. The not so obvious risk, although it's a shorter term risk, is the risk of the present government not getting voted back to power. Looks unlikely given what's happened last year, but I'm always reminded of what happened in 2004 when everybody expected Mr. Vajpayee to come back, but he didn't. So that may disrupt the entire momentum for a few months. Although while calling out both these risks, I must also let you know that India's growth momentum over the medium to long term will not get impacted by events that I just called out. It may lead to the markets correcting 5, 10, 15%, who knows, even 20%, but these are not events which can disrupt the big picture for India. And that big picture for India is very solidly placed, bases its demographics, bases the middle class consumption, and the third driver now, which is basically manufacturing exports. So I thought I should just segregate the short term versus the medium to long term. Yeah,
most certainly, and that helps. And so thanks for putting it out. Ajay, we'll talk about the why of the lifting the stones and identifying in a bit, but I would love to talk about the what before we hit into the break. So when you have lifted the stones and looked at the underlying businesses at the broader end of the spectrum, right, what are those areas or pockets where you believe, given the risks to the markets, what are those areas where you believe that the possibility of gains continuing, not necessarily just for 2024, I know you invest with the longer term horizon, but for the gains continuing because of the business prospects? Sure.
I would say the one very obvious one staring into our face, Niraj, are the private sector banks in India. I think for a variety of reasons, we've seen, despite business being strong, and we are still talking about India as an under-penetrated country in terms of credit, there are obviously huge opportunities towards lending itself. And apart from that, other facets of financial services, whether it's insurance, asset management, wealth, and so on. So I would say some of the private sector banks have really not gone anywhere over the last few years, despite their business model being as robust as it always was, and despite the fact that we see them accreting and increasing their market share over the next 5-10 years. So that's the most obvious one. The other one which has been impacted and looks attractive to us is the consumer staples and the consumer durable space. Yes, there has been some weakness in discretionary spending in our country. Therefore, a lot of these discretionary names, a lot of these consumer services companies, which includes restaurants, and also consumer staple companies, haven't gone anywhere, and therefore their valuations still look to be attractive. Like I mentioned earlier, to our mind, India is about a very strong middle class consumption over the coming decades. And if that's to happen, you can't ignore the business models which are going to be front and center in terms of a typical consumer basket. So, I would particularly call out these two sectors.
Okay, but I'm presuming those would have a larger cap bias or not quite.
I would say as far as the banking sector is concerned, yes. But as far as consumer staples and discretionary is concerned, all the way from small to large. Yeah.
Great. So let's take a break on that note. We need to slip into one, I presume. We come back from the break and talk about the why on the themes that Ajay Tyagi's mentioned. Stay tuned. We'll be right back. back with Talking Point in conversation with Ajay Tyagi. And Ajay Tyagi mentioned before the break about how he's constructive on financials, select band of financials, of course, and he's constructive on consumption, staples and others as well. Now, I'd like to start with the latter first, Ajay, if you allow me, and that is on consumers. There is a bevy of very smart stock pickers who run portfolio management services firms who talk about how discretionary consumption and the upper crust premiumization theme is probably the best way to play consumption as India's per capita grows from where we are to where we will be in 2030. I wonder if you concur or do you have a different view there?
I would certainly concur with this observation, but Niraj, I would say India, as many economists and many market observers, practitioners, and corporate captains would say, India is about many markets. And even if you don't want to divide it into many markets, even if you want to divide it into two simple segments, it's about India and Bharat. Now, while the observation around premiumization is very true for India, people like you and me and many of us in the bigger towns, cities and state capitals are premiumizing all the way. But equally, look at the rural part of India. Many of them haven't even gotten started. We're talking about consumption habits here. Look at the discretionary items that you and I are using. They haven't even begun using and consuming many of those products or services. So the beauty about the Indian market, and that keeps us excited about the entire consumption pact for many years, I'm sorry, and should I say for another couple of decades, is the fact that at one end of the spectrum, there are people who are yet to try out many of the discretionary products and services. At the other end of the spectrum are people who are constantly premiumizing because humans by their very nature are aspirational, and as income levels move up, people also want to move up, the premiumization ladder. Yeah.
Okay. But would the relative growth be higher at the premium end or not necessarily so?
I wouldn't say it would be higher there, but I would also say if you take a step back, many companies are having a business model which is trying to attack both ends of the spectrum. Of course, I know that there are companies which are only on the premium end, but there are many companies which are trying to target this at both ends of the spectrum. So, I wouldn't. So just look at the success of a player like Trent over the last 10 years. They haven't basically talked about the premium end at all. They're just playing the lowest end of the market, if not the lowest end, certainly the lower end of the market, but having a value for money proposition for the customer at that lower end, and they've created a very, very successful business model. So, I would say it happened at both ends, and there are, by the way, certain companies which are trying to straddle the entire spectrum.
Got it. Viewers, remember standard disclaimer. It's used as an example to illustrate the point that Ajay Tyagi is making. Don't use any of the things that we've discussed as recommendations on the show. Ajay, thank you for illustrating it, though. That's beautiful and a great point to make. The other thing is staples. We've largely seen them disappoint investors thus far. There's a lot of chatter around how rural is hurting and there might be government support. We don't know if that will happen, but is that, it may be a necessary condition, but is that a sufficient condition for the stocks to do well? And would you invest into them because of such a belief that the government support at some point of time helps these stocks?
No, Niraj, not quite. That's never been our strategy at UTI to actually look at business models with the expectation that some external factor may come in support. We always look at business models basis the inherent strength and the inherent opportunity that those businesses have in front of them. So that's certainly not the case. But you're right in your observation that this sector hasn't done well. Most of the stocks, except for a few, have not done well in the last few years. But that's also because of a very high starting point in terms of valuation. So that may have been a factor that's gone against them. And of course, the second factor has been that rural India hasn't done well, and therefore the volume growth for many companies in this sector hasn't been strong. But many of these factors are just transitory factors. As far as valuations are concerned, they've already now reached to a level which we think is very close to the long-term averages. As far as rural demand is concerned, I would say we've seen a strong uptake in some segment of the market, which is like two-wheelers. And if that can be used as a precursor, I would say that, the other segments of consumption, particularly consumer staples, which also have been negatively impacted on account of weakness in rural India, should also see some bit of strength in the coming quarters.
Okay. And Ajay, my final question is on financials. Now, I know you mentioned private banks, lending financials looking very strong. A lot of conversation and chatter around the non-lending financials. I mean, AMC companies as one because of the quantum of growth that will come into that business, or insurance companies as well, or capital market plays. I'm trying to understand if you are constructive on any of these with or without, and reasons thereof.
Sure. So I would say, Niraj, many of our funds do have exposure to, these financial services firms. But at the same time, let me also, express my views that we find that, banks, which basically are full service financial institutions, which means that apart from banking, they do have a very strong asset management arm or an insurance arm or a wealth arm or a broking arm. To my mind, are better placed and a more, I would say, non-cyclical way of playing financial services, because many of these business models that you just mentioned do go through their own cycles, and sometimes these cycles can be very, very vicious. In fact, the regulatory landscape in India is also evolving, and therefore you keep getting some of these incremental regulations which may be dilutive towards the profitability of either asset managers or insurance companies and so on. So while yes, in some of our funds, we are directly playing the financial services theme, but on the whole, we just feel more comfortable owning a financial institution which basically incorporates all ends of the spectrum. Yeah.
Got it. Okay. So constructive Ajay Tyagi on markets at large, save for a few risks that he highlighted. Ajay, such a pleasure talking to you today at the last episode of 2023. Look forward to talk to you more often in 2024.
Thank you very much, Niraj, and wish you and all your viewers a great 2024.
To you and team and family, Ajay. Thanks so much for taking the time out and being with us today. And viewers, with that, it's a wrap on this leg of Talking Point. Thanks so much for tuning in. But stay tuned. Lots more coming up on NDTV Profit.